surprise guest. An unwilling surprise guest. So I've been somewhat uninspired by reading the Wall Street Journal. So I thought I would interview my dearly beloved, and he's not been sold on the idea, but we're gonna give it a try anyway. So, but first, I did find an article of some interest to me, so I will start with that. It is Brazil returns to double-digit inflation for the first time in years. And it's really just highlighting that Brazil now has over 10% inflation. And as the city, or as the country has the high level of immunity that allows life to get back to normality, there is pressure on prices that were depressed during the pandemic, especially services. And so they're just really, there's also local factors that have impacted this, and it's been particularly hard on the poor who all have suffered during the pandemic with unemployment. And then there's broader political implications in Brazil of the inflation, because older generations are still haunted by the memory of punishing hyperinflation of the 80s and 90s. So the rising prices will impact the future of policy. And so that's one impact of the inflation. Another impact is that, or another cause of the inflation is that there's been a severe drought, the worst in almost a century. So their hydroelectric reservoirs have not been able to function, so they've had to use more expensive thermal plants. So you've just got all these things compounding, which, by the way, a lot of produce and a lot of produce for other countries comes from Brazil. So that drought has impacted crops and cattle feed, driving up the price of meat by nearly 25% and the price of rice by over 11%. All things that you would see as you go to the grocery store, because we are also having not as significant inflation in Brazil, but we are having inflation now, and it's more than we've seen in a while. So at this point, I'm going to ask Eli what is one thing he does to protect himself from inflation.
Well, so take anything I say with a grain of salt, but to me, if you have 10% inflation and you have to make 10% on your money just to maintain the status quo annually. So if you remain in your current job and you don't get any raises, you're essentially making less over time. I don't have any strategies for fighting inflation or anything, but you would want to look at your investments that are inflation, that aren't impacted by inflation. So one investment would be land. Inflation does not harm land's value. In fact, by the very definition, inflation is you're going to get more money for the same land, so to speak. Gold fluctuates in value, land fluctuates in value, but pretty much it only goes up. But gold fluctuates more, but it's a more inflation tolerant investment. touting these. Well, land I would tout. Buying a piece of land, unless you buy it in some subdivision that's already developed and it's a plot that nobody wants, there's that risk. But by and large, land is a good thing to buy. And the more you have, it's like money in the bank.
Yeah.
So, as far as investments, your average stock, you're doing good to make 9% a year annually. Even in index funds, you're doing good to, roughly 9% is good. But if your country's inflating at 10%, you're still losing money, or losing value, I should say.
That's a good point. There's a difference in losing money and losing value.
Yeah.
And that's not always quickly understood.
Yeah, all money is a container of value, so to speak. Kind of like a battery is a container of energy. So different monies have different capacity for containing value. So one thing I would look at, this wouldn't be necessarily new for new investors, but if you want to make more money on your money that you've invested, options are definitely a good thing to get into, especially LEAPs, and that's long-term equity anticipation securities. So, options are risky, even more so than just buying and holding a stock, but with risk comes higher reward. So
never invest more than you can afford to lose.
And don't take this as financial advice, because I'm not a financial advisor, yeah. But I have made 200% on at least 2 options, 2 LEAPs. And LEAPs is it's not a plural term, it's a singular term. And that was in a short period of time. I've only been trading LEAPs for probably a year. So, and I've made money on others. I've lost some money as well. So you can lose it as quick as you make it. But overall, if you buy a LEAP or LEAPs, if your underlying stock goes up, if you buy a good quality company, you're typically going to make money as that company increases in price. So one thing you want to, this is with any investment, one thing you want to do or have the mindset of, especially in options, is that you don't want to risk more than you're prepared to lose. And that's especially true with options, because it's exponential. You buy a stock and it's more linear. When the stock goes up, you're making money. When the stock goes down, you're making money. Well, LEAPs is exponential, so you can lose all your money really quickly. You can also gain money really quickly. So, keep that in mind. I would, people say set stop losses and all this jazz. An option is a stop loss, so to speak. So don't put large sums of money in a single option, because, it could go to zero, or it could double, in a month or less. I had one that was up 800%, and I sold it on the way down at 200% profit. So, you know, they move faster, and with an option, I would encourage anybody just to definitely do their research and options on how they work, because it's a little more complicated than stocks. You have a set time frame with options, so a typical leaps time frame would be a year or more. So you have, you know, if that option expires after a year, you hold onto it a year, and it expires. If it's in the money, what they call in the money, say the price of the underlying stock went higher than the price for the contract you bought it at, then if it expires in the money, it automatically what they call exercises, which means you buy 100 of the underlying shares at the price of your contract. You don't have to do that. You can trade them just like you can trade stocks. You can sell it beforehand and avoid that. So, and I would say, and I didn't mean to make this an option conversation, but there's a difference, and you'll read options and you'll get all confused. You'll read about options and get all confused, but there's a big difference that, you know, I wish somebody would have explained to me. So there's a difference in buying to open and buying to close, and same way with selling. There's a difference in selling to open your position and selling to close your position. So there's certain things, like if you're a beginner, you don't want to sell to open or buy to, or, well, not buy to open, but you don't want to you don't want to be riding the contracts, so to speak. If you're just starting out in options, you're wanting to buy other contracts. So a call is you're anticipating that the underlying stock is going up, and with a call you'll make money as that underlying stock goes up. If you buy a put, you're buying a put that somebody else wrote. You're betting that the underlying stock's going to go down, and you'll make money from that. When you ride an option, you're selling to open. So you're selling a call or put to somebody, a contract to somebody else, and that puts a lot more risk on you. It could be, I mean, realistically, it's not going to be, but you could, under certain circumstances, you could have infinite risk. So be careful if you're going to start doing that. But when you buy somebody else's contract that they wrote, your risk is only the money you put into it. So just remember that. And it's not well explained on a lot of the stuff I've read about options. That's not well explained, and I probably didn't do it. I didn't explain it that well either. But just remember, you know, when you're selling to open, that can represent a lot more risk than if you're buying a contract that somebody else has written. So, you know, if also back to the exercising, if it's in the money and you just let it expire, it's automatically going to exercise. So you got to have the money in your account to buy 100 shares. This is assuming one contract. You have to have the money in your account to buy 100 shares, or you're going to get in trouble with your broker. Which even, there's not a lot of risk in that, because your broker will it'll exercise, and then the broker will immediately sell it. So that's only if it's in the money. If it's out of the what they call out of the money, then it expires worthless. So, but if you're new, I would definitely sell to close any contracts you have bought well before expiration.
So from a question of inflation, we have covered real estate, a little bit of real estate, and a lot of options.
Yeah. Sorry.
So, thank you for imparting your knowledge on us. We will be back with another installation with some Eli knowledge, because he's got a lot. Until then, we will see y'all later.
Peace out.